How do capital gains taxes work when selling a rental property? Have you ever wondered what happens to your taxes when you sell a rental property? Understanding capital gains taxes is essential for any property owner. Let's break it down step by step. When you sell a rental property, capital gains tax applies to the profit you make. The capital gain is calculated by subtracting your property's adjusted cost basis from the net selling price. The adjusted cost basis usually includes the original purchase price plus the cost of any improvements made to the property, minus any depreciation claimed during the rental period. First, you need to determine the cost basis. This is the original purchase price of the rental property, plus any capital improvements, like renovations or additions. You also need to subtract the total depreciation deductions you have taken over the years. Remember, depreciation reduces your cost basis because it reflects wear and tear accounted for as a tax deduction. Next, calculate your net proceeds from the sale. This is the selling price of the property minus selling expenses such as real estate commissions, legal fees, and any other costs directly related to the sale. Now it's time to calculate your capital gain. Subtract the adjusted cost basis from the net proceeds. If the result is positive, you have a capital gain. If it is negative, you have a capital loss. The type of capital gain matters too. If you own the property for more than 1 year, it is considered a long-term capital gain. This type usually gets taxed at lower rates compared to ordinary income. If you owned it for 1 year or less, it is a short-term capital gain and taxed at your ordinary income tax rates. Another important aspect is depreciation recapture. When you sell a rental property, the Internal Revenue Service requires you to recapture the depreciation you claimed during ownership. This means the amount of depreciation is taxed at a special rate, which can be up to 25%, separate from the capital gains tax rate. Tax rates for long-term capital gains vary based on your income and filing status but are generally lower than ordinary income tax rates. Short-term gains are taxed at ordinary income tax rates, while depreciation recapture is taxed at a maximum rate of 25%. When it comes to reporting the sale of rental property is reported on Internal Revenue Service Form 4797, along with Schedule D for capital gains and losses. You may also need Form 8949 if applicable. Rental income and expenses during ownership are reported annually on Schedule E, which is for supplemental income and loss. Keep in mind that the outstanding mortgage balance on the property does not affect the capital gains calculation. Capital gains tax is based solely on the difference between the adjusted basis and the net sale price, regardless of any mortgage payoff. If you sell the property for less than your adjusted basis, you may have a capital loss. This loss can offset other capital gains or, in some cases, ordinary income subject to limits. And like a primary residence, rental properties do not qualify for exclusions on capital gains. For primary residences, you may exclude up to $250,000 or $500,000 if married filing jointly, under certain conditions. Before selling a rental property, it is important to calculate your adjusted basis carefully. This includes accounting for depreciation recapture to estimate your potential capital gains tax liability. You may also consider strategies like a Section 1031 exchange to defer capital gains tax by reinvesting in another like-kind property. Understanding these details can help you navigate the tax implications of selling your rental property effectively.